Dupont analysis actually it is a framework. This framework was first developed by Dupont, a company or a corporation that established in the USA. Chemical industries. DuPont, in the name of DuPont, they try to a framework by operating margin and operating efficiency or financial leverage. There are three steps to measurement the earning capacity or efficiency of a company. First part, operating margin, operating efficiency, and financial leverage. These three parts they try to a framework. This framework is called a DuPont analysis. Actually, this DuPont analysis are measurement the capacity, earning capacity or strongness of a company. That is disclosed by this framework or formula. There are a simple definition, a framework for analyzing the fundamental performance popularized by the DuPont Corporation. The first criteria or first step of DuPont analysis, return on equity, a measure of financial performance calculated by dividing net income by shareholder equity. The how much shareholder equity were able to return in short period, how much capacity or how much earning capacity by the shareholder equity by use of equity. Equity means a core capital of a company or those shareholders who have a right to take a decision, who have right to giving the voting power. This is the equity shareholder, and the capital or the amount of equity shareholder is the equity. So equity come from equity shareholder. Equity shareholder are hold the maximum right or power of the company. So how much capacity of a company to properly utilize the shareholder equity to earn the benefit, to earn the money of a certain period. This is the return on equity. A return on equity is the first step of DuPont analysis. So DuPont analyzes the company efficiency, company earning capacity, company financing leverage, how much strongness that is indicated or that is disclosed by the framework. This is the DuPont analysis and a framework. The simple formula, there are three steps. DuPont decomposition of ROE. At first, ROE, net income, average shareholder equity. Step number 2, net income, average total asset into average total asset into average shareholder equity. This is part of leverage. This is the ROA. And last step, net income divided revenue into average total asset. Average total asset divided average shareholder equity. That is three part: net profit margin, asset turnover, and leverage. If we simplify by revenue and cross, average total asset cross. That's when finally we get net income and average shareholder. This is a very fantastic and very popular formula to find out the return on equity. This is the technique and this is the tools of DuPont analysis. So you have to first category, net profit margin, this is this formula. Asset turnover, this formula. Leverage, this formula. Leverage means financial leverage. Leverage means how much earning capacity by increasing the sales of power of a company. That indicate by leverage. Asset turnover means how frequently the assets are converted in earnings, or how much less time we can convert the asset turnover, or how much we can convert the liquidity, the inventory. This is the asset turnover. A net profit margin, the how much income are generated from the selling. This is the net profit margin. So to find out the return on equity, we can follow the 3 steps. First step, net profit margin. Second step, asset turnover. Third step, leverage. Combinedly, we can call return on equity. And if you can simplification by this broad segment, we can get a single segment by simplifying. That is where net income and revenue. Revenue and average operating as total asset. So you try to revenue and this revenue, you try to cross. So ultimately you will get net income divided average total asset. Side by side, average total asset, average shareholder equity. If you try to simplify, average total asset cross, average total asset cross. Ultimately, you will get revenue divided average shareholder equity. Very simple. This we can simplify by 3 steps. This techniques and this framework is called Dupont Analysis. This Dupont Analysis at first used by Dupont Corporation in USA, the chemical industries. From that, the Dupont Analysis are published or disclosed over the world, even a textbook. So it is a very crucial technique to find out the return on equity. Basically, return on equity is it shows the strongness of a company. How much equity fund we are able to use to promptly get the return. This is the actual efficiency or actual capacity to utilize the return on equity or equity fund. So if you absolutely properly use the equity fund, because equity fund is comparatively less risk and save investment, save return. So this equity are most priority of a company comparatively third parties. So now I am going to something say about the DuPont analysis or DuPont framework. DuPont the Nemours Incorporation, the full name of the company, commonly shortened to DuPont, is an American multinational chemical company first formed in 82 by French-American chemist and industrialist. French and American chemists and industrialists have combinedly tried to establish this organization. So, Elisha Irene Dupont de Nemours. This is the total or completely name of the company. The company played a major role in the development of Delaware and first arose as the major supplier of gunpowder. There are major suppliers of gunpowder. Their product was gunpowder. Okay, this company established by 2 countries combinedly, French and American French chemist and American industrialist, and they try to build up this company. And this company first analyzed the Dupont analysis. That's mean ROE, return on equity, how we can determine, how we can use, how we can uh, utilize this fund or liquidity. This is the actual fact of Dupont analysis. A Dupont analysis is nothing else, just to determine the capacity, especially earning capacity or strongness of a company that is justified by the formula or framework. Dupont analysis are meaning ROE, we can call net profit margin, assets turnover, and equity multiplier. Combinedly, we can simplify by ROE. So these three crucial points are held by ROE. So ROE is a very strongness of a company, very strong financial tools of a company. On the basis of the ROE, a company are survive or run. Without ROE, you cannot survive or you cannot run the company or organization. Actually, the ROE are main key role clear to run the company. So the three dimension, very big or very concerning three dimension they handle. Number one, net operating margin, asset turnover, or equity multiplier. So there are also specific formula, net operating margin, that means net income divided sales, turnover, turnover, there are specific formula, total average asset and sales or revenue and total average operating asset and equity multiplier. There have specific formula, net operating total average operating asset and revenue. And then we can simplify three steps by a single step: revenue and total average operating asset. This is a very simple, but this simple figure we can uh, determine by analysis by three angle. This is the root tree diagram, Dupont model. At first, return on investment or return on equity same, then profit margin, then asset turnover. This is asset turnover, this is the angle, and profit margin, this is this angle. Combinedly, we can call very simple definition ROE, that's mean ROI, return on investment. Dupont analysis, another detailed elaboration, formula by formula. At first, net profit margin, net income divided revenue, and net profit margin, net income and revenue. Then we can determine by three head: tax burden, interest burden, operating profit margin. These three dimension we can combinedly call net profit margin, net income, EBIT, EBIT, EBIT. EBIT means earning before tax, and EBIT means earning before interest and tax. Then operating profit margin, EBIT divided revenue. We can call combinedly net profit margin. Again, asset turnover means revenue, average asset, financial leverage ratio, average asset, average equity. This origin from asset turnover and financial leverage ratio. This financial leverage ratio combined we can call equity turnover. Equity turnover means revenue divided average equity. And ultimately at last stage, return on equity. That's the net income, average equity. So this consequence formula we can combinedly call Dupont analysis. It is a technique to justify, to determine the capacity or efficiency of a company or strongness of a company, how much strongness shows by the company, how much they are asset to meet up the liabilities. That is the shows or that is the focus by determining this formula. So this Dupont analysis technique is critical or strongness formula to disclose the Dupont analysis. There are simple method to determine the ROI or ROE. So you carefully read. Gradually, I try to solve the mathematical problems.